Welcome! In this segment, we will recap the internal capabilities and external market dynamics impacting Crocs. Following this, we will present strategic recommendations designed to enhance Crocs' competitive positioning within the evolving footwear industry. Let's begin. The footwear industry faces a complex landscape shaped by political, economic, social, technological, legal, and environmental factors. Trade tensions, especially U.S.-China tariffs, raise supply chain costs for Crocs. Geopolitical conflicts and new global tax rules, like the OECD's 15% minimum tax, add uncertainty. Inflation and high interest rates raise costs and reduce consumer spending. Currency fluctuations also affect Crocs' revenue and expenses globally. Trends toward comfort and leisure favor Crocs, with Gen Zs and millennials demand sustainable, ethical products, and social media heavily influence purchasing. Advances in materials and AI improve comfort, reduce waste, and enhance online shopping through features like virtual try-ons and chatbots. Crocs must follow labor, consumer protection, and data privacy laws. IP protection is key to avoiding counterfeit theft. Sustainability efforts like recycled materials and take-back programs are growing. However, climate risk and political resistance to ESG rules may disrupt progress. Moving on to Reporter's 5 forces. The threat of new entrants is low due to high costs in branding, supply chains, and tech, though e-commerce slightly lowers barriers. Substitute threat is high, with many alternatives like sandals and counterfeits and easy brand switching online. Supplier power is moderate as most materials are widely available and major brands reduce reliance through vertical integration. Buyer power is also moderate. Consumers can easily switch brands, but strong brand loyalty limits their influence. Competitive rivalry is intense, driven by constant innovation, seasonal drops, and direct consumer strategies. Overall, it's a moderately attractive industry where strong brands can thrive, but new players might face tight margins and high barriers. In this analysis, we consider Nike and Skechers as Crocs' key competitors. Nike dominates with innovation and a strong global brand, while Skechers excels in affordable and comfortable casual footwear. Both pushes Crocs to keep evolving and stay competitive in the footwear industry. We'll now look at the financial performance of Crocs compared to its key competitors from 2020 to 2024, focusing on revenue and year-over-year growth. Nike led in revenue growth but saw slowing momentum. Skechers also showed steady growth, reaching 12.11% last year. Crocs had explosive early gains but slowed significantly to 3.53%. This reflects the saturated market industry. In terms of profitability, Crocs leads in operating margin and has the lowest COGS. Nike shows stable but lower margins with higher COGS. Skechers stays in the middle for both. Overall, Crocs appears to be the most profitable based on these metrics. Crocs maintain high inventory turnover and a short cash conversion cycle, meaning less capital is tied up in operations and more cash is available to support profitability. However, Crocs' liquidity was comparatively constrained with a current ratio of 1.18 and a quick ratio of 0.70, reflecting debt incurred from the Hated acquisition and increased working capital requirements. Nike, by contrast, maintained the strongest liquidity, while Skechers held a balanced position supported by organic growth financing. On leverage, Crocs initially saw a rise in its debt-to-equity ratio following the acquisition, but improved its capital structure over time, lowering the ratio to 0.93 by 2024 and increasing its interest coverage to 9.35. Nike managed stable debt-to-equity ratios and has since achieved earnings from interest, while Skechers remained the most conservative, minimizing financial risk. Despite its standout profitability, Crocs trades at a modest valuation, indicating investor caution about the sustainability of its growth and product appeal. In contrast, Nike commands premium valuation multiples, reflecting its strong global brand and investor confidence, while Skechers sits in between. Let's now evaluate the internal strengths of Crocs, Nike, and Skechers. Crocs thrives in its iconic foam clogs, comfort-focused branding, and strong direct-to-consumer model. These capabilities support its growth and profits, but most are easy to replicate. Its standout is the comfort fashion niche, which offers a temporary edge. To sustain success, Crocs must keep innovating and expanding its brand appeal. Nike holds long-term competitive advantages through its global brand equity, athlete endorsements, and proprietary technologies like Flyknit and Air. These resources are valuable, rare, hard to imitate, and well leveraged, giving Nike a lasting strategic edge and market leadership. Skechers competes with a wide product range, comfort tech, and efficient distribution. These trends are valuable, well managed, but not unique. As a result, Skechers remains at competitive parity and can benefit from deeper brand identity or innovation to stand out. Now, we'll explore how the three companies differ in four key strategic areas. First, for product differentiation. Crocs stands out with comfort-focused lines and creative collabs expanded by its hated line. Nike leads in tech-driven performance products with exclusive drops. Skechers focuses on everyday comfort and accessibility. For focus strategy, Crocs targets lifestyle users seeking comfort and style. Nike zeroes in on niche markets through customization and cultural relevance. Skechers aims at the mass market, prioritizing affordability and reliability. For marketing strategy, Crocs uses viral trends and TikTok to spark buzz. Nike builds emotional brand power through athletes and innovation. Skechers sticks to broad, relatable endorsements to emphasize comfort. For geographic expansion, Crocs is scaling fast in India via digital platforms. Nike localizes the strategy, mixing custom products and youth programs. Skechers expands through retail growth, especially in Europe, the Middle East, and Latin America. Let's shift to the operations behind the numbers with a value chain analysis. Starting with inbound logistics, Crocs uses its proprietary cross-light material, advanced inventory systems, and strict quality checks. Nike relies on large-scale outsourcing with a just-in-time model, while Skechers sources conventional materials with basic tech integration. In operations, Crocs combines full outsourcing with lean, sustainable production focused on cross-light. Nike blends both outsourcing with sustainability through recycling. Skechers also outsources but puts less focus on proprietary materials or sustainability. For outbound logistics, all use regional hubs and e-commerce. Nike leads with RFID and direct consumer channels. Crocs streamlines omnichannel tracking, and Skechers boosts efficiency through automation. In marketing and sales, Crocs leverages viral campaigns and inclusive messaging. Nike dominates with athlete endorsements. Skechers uses both positioning with strong omnichannel marketing. For service, all offer returns and support. Nike stands out with product customization and app features. Crocs focuses on loyalty and user-generated content, while Skechers uses AI and CRM tools. Now, to support activities. Firm infrastructure. Crocs focuses on scalability and cost efficiency. Nike leads ESG and growth strategy. Skechers support global growth with a cost-focused model. For HR management, all value safety, training, and diversity. Nike has the most structured development paths. Skechers emphasizes recruitment and recognition. Crocs focuses on training and internal development. Technology development. All invest in AI and product innovation. Nike leads in R&D and sustainability. Crocs advances automation and cross-light tech. Skechers uses cloud tools and consumer insights. Lastly, procurement. All promote ethical sourcing and long-term supplier ties. Nike leads with blockchain traceability. Crocs highlights procurement part. Skechers enforces compliance through third-party standards. Let's take a quick look at the core strengths of the three major footwear companies. Crocs stand out with its proprietary cross-light foam and bio-based innovations, delivering lightweight comfort. Their iconic clogs drive product recognition, supported by pop culture marketing and over 390 global retail locations. Nike leads in performance innovation with technologies like Air Max and Flyknit. The brand offers a wide range of athletic and lifestyle products, backed by top athlete endorsements and a global network of over 1,000 stores. Skechers, on the other hand, focuses on comfort-first technology. Its diverse product line spans athletic, casual, and workwear, reaching a broad audience, although more than 5,000 retail outlets and comfort-centric marketing. Each brand leverages unique strengths in tech, design, retail presence, and branding to compete in the global market. The strategic roadmap of the footwear industry reveals clear positions based on price, product line, and market share. Nike leads with premium pricing, a broad product line, and a dominant 46.22% market share. Under Armour and Dockers also target the high-end but with smaller shares. Skechers competes in the mid-price range with wide offerings and a strong market position. Crocs and designer brands focus on lower prices and narrower lines, appealing to value-driven buyers. Columbia Sportswear sits between mid and premium tiers with moderate variety. Overall, pricing and product breadth strongly influence competitive positioning. As the footwear industry evolves, several future key success factors will determine who stays ahead. Rapid product innovation and tech integration top the list, critical for staying relevant and justifying prices in a fast-changing market. Agile, resilient supply chains are equally vital, with global disruptions demanding brands adapt quickly or risk severe setbacks. Direct-to-consumer channels are rising in urgency, offering better margins and control in the face of tariff-driven costs. Cost control is essential for survival, especially amid inflation. Brands must act swiftly to protect their bottom line. Meanwhile, brand storytelling and community engagement remain important for long-term loyalty, even if they don't solve short-term threats. Global expansion offers future growth but isn't a current priority due to economic volatility. Finally, offering price points consumers are willing to pay matters, but it depends more on perceived value than control. In short, success will come to those who can innovate fast, stay flexible, and control both cost and connection with consumers. When assessing competitive strength based on future key success factors, Nike clearly leads with an overall weighted score of 8.88, driven by top ratings in innovation, supply chain agility, global reach, and brand storytelling. Crocs follows with a score of 7.8, showing solid performance across all categories, especially in cost control, DTC channels, and pricing strategy. Skechers scores 7.34, performing well in cost control and supply chain agility, but trailing in innovation and brand storytelling.
And now let us explore the SWOT analysis of Crocs. Strengths include a unique product differentiation, strong brand recognition, a broad omni-channel presence, efficient operations, experienced leadership. Weakness center around the limited product design appeal, heavy reliance on signature clogs, and the underperformance of the hated brand. On the opportunity front, there's a potential sustainability trends, AI-driven e-commerce, health-conscious consumers, global expansion, and better legal protections for IP. However, key threats loom: geopolitical risk, economic instability, rising legal costs, shifting consumer preferences, environmental disruptions, and reputational risk tied to ethics. Our SWOT matching shows that we can use our case strengths, sustainable product differentiation, strong brand equity, a robust omni-channel presence, seasoned global leadership, and efficient, compliant operations to seize opportunities in e-commerce, AI-driven marketing, demographic expansion, and international growth while safeguarding our intellectual property. At the same time, we will turn our weakness into advantages by refreshing product design, diversifying the portfolio beyond signature items, integrating cutting-edge technology, and tightening IP protection. These moves also help us counter threats in agile innovation and brand credibility, defend against shifting consumer ethics and reputational risk. Diversified channel and expert leadership buffer geopolitical and economic shocks, and operational flexibility mitigates legal, environmental, and supply chain disruptions. And together, these coordinated strategies position for resilient and sustainable growth. Now let's move on to the alternative course of action. Crocs faces a key challenge: over-reliance on clogs. To overcome this, the main strategy is product diversification. Alternative ones suggest expanding the hated brand, positioning it as Crocs' casual urban sibling aimed at Gen Zs and the millennials. By using Crocs' global reach and comfort tech, this lowers the reliance on clogs and taps into the lifestyle segment. Though brand positioning is a challenge, it aligns with the Crocs' strengths. Alternative 2 explores launching Crocs branded apparel and accessories. While it offers growth potential, it requires heavy investment and faces tough competition. Based on our decision matrix, Alternative 1 scores higher, 3.52 versus 2.6. Our recommendation is to pursue the hated expansion. It lowers risk, asset efficient, and support Crocs innovation while expanding its market appeal. We will now proceed with the implementation plan. The group recommends strategic expansion for Hey Dude. A 12-month phase implementation is presented aimed at scaling operation, growth market share, and aligning brand identity. And let's begin with a visual overview of the timeline. Here's a visual overview of the overall plan. We've broken the expansion into 4 key phases. Phase 1, project assessment and alignment. Phase 2, operational scaling. Phase 3, market penetration and brand elevation. Phase 4, evaluation and improvement. Each phase spans approximately for 3 months and includes both strategic and operational initiatives. Let's explore each phase in more detail, and we will start with the Phase 1. Phase 1, project assessment and alignment, is all about the strategic groundwork. We begin by establishing clear, measurable goals, whether it's from revenue, margin, or retention. We also work to integrate HeyDude's identity into Crocs' core comfort-driven values. Operational assessments, especially around the logistics and tech systems, we will ensure we're building a strong foundation. And once the groundwork is set, we will move into the operational execution. Phase 2. Operational scaling is where strategy meets action. We will launch pilot markets to test retail partnership and international potential. At the same time, we will update logistics and fulfillment models to accommodate the new SKUs. Importantly, our team, from sales to finance, will be incentivized and resourced to drive success during the scaling. Once we build out the core structure, the next step is to activate the brand more fully in the market. Phase 3. Market penetration and brand elevation is where we amplify the brand to push into deeper market penetration. The Comfort Reimagined campaign will enforce HeyDude's value proposition in its line with Crocs' DNA. We'll also explore cross-brand collaboration and add seasonal products drops to stay culturally relevant. Crucially, we'll use the customer feedback to steer real-time product and service improvements. With the brand activated, it's now time to evaluate the impact and prepare for the future phases. The final phase is about evaluation and improvement. We'll review performance data across major dimensions: financial, operational, and customer experience. Successful pilots will be scaled and any lagging efforts discontinued. This is also where we begin laying out the foundation for new verticals such as lifestyle and apparel. And finally, we will deliver a year-end strategic summary and outline of the roadmap ahead. And now let us talk the balance scorecard. Let's kick things off with our financial goals. The focus here is about expanding HeyDude's footprint through smart investment and operational efficiency. First, we're working to diversify the revenue base with an ambitious target of having 30% of total revenue coming from HeyDude by the end of the third fiscal year. This will be achieved by leveraging Crocs' powerful direct-to-customer and retail network and by launching new, trend-driven lines for women and urban customers. Next, we're focused on improving the gross margins, and this will be achieved through strategic sourcing consolidation and introduction of high-margin hybrid SKUs, and we aim to push the margins to 55% more by the third fiscal year. And finally, we're maximizing return on investment by aligning marketing spend with the performance matrix and tightly tracking the return on investment by the market and channel, all to ensure HeyDude's success isn't just stylish, but profitable too. From a customer perspective, we're laying foundation for global brand love. Our goal is to elevate HeyDude's presence internationally, especially in Europe, Middle East, Africa, and Asia Pacific. And this will be done through influencer campaigns, regional ambassador, and co-branding partnerships. To deepen the loyalty, we will roll out a HeyDude app, give early access for exclusive products, and celebrate customer stories in our marketing. All this aims to lift our Net Promoter Score to 60% by the end of the third fiscal year. And when it comes to market share, we're not walking, we're running. By positioning HeyDude as the stylish yet orthopedic-friendly choice and targeting fashion-forward cities with women-led product lines, we're aiming to grow our share to casual footwear by 5%. Internally, we're making serious strides in product and supply chain efficiency. Time to market for our new HeyDude styles will drop from 9 months to 6 months, thanks to agile development and co-located research and design team. We are also integrating Crocs' proven technology into more HeyDude products, and our goal is for at least 25% of our SKUs to feature innovations like Light Ride. And finally, we're strengthening our supply chain resilience, increasing our on-time in full delivery rate to 95% by expanding our vendor base and applying AI for smarter demand forecasting. No strong brand thrives without strong people. In our learning and growth initiatives, we're investing in talent across both brands. Training our expert team member will be doubled, supported by the brand summits and internal certifications. To ensure everyone's aligned, we will use quarterly surveys and roll out a global HeyDude playbook to drive internal brand clarity. And finally, we're fostering innovation through cross-functional collaboration. With innovations fads, Hack Weeks, and shared product dashboards, we will raise collaboration satisfaction by 80%, ensuring our teams innovate together and win together. And that would be all. And once again, this is Emotional Consulting. Thank you and have a good day.